the reason why I really want to look at the origin story, because I think it helps people understand where this concept of an NAV multiple comes from. Because today it seems like some commentators view it as almost alchemy, and that it's too good to be true. But establishing kind of the history of the company, I think, helps clarify where that's coming from. So how would you describe the NAV multiple, and what its reason to be is?
I'll start with there are many companies outside of Bitcoin Treasury companies that trade at a multiple to what you might consider their net asset value, right? And if you take a traditional company, a net asset value would be a combination of the assets on its balance sheet and a discount on the sort of earnings projections, right? Like, and so if you're to combine those two things, right, like, I was just talking to folks at one of the banks that we work with, Morgan Stanley, right? They trade at a multiple. I don't know exactly what it is, but it's 1.5 to 2.5 times their net asset value, right? And so why does a company like Morgan Stanley trade at a multiple net asset value? Well, one, you may believe that the earnings potential is growing at such a rate that whether you look at 1 year, 5 years, or 10 years out, you think the potential is greater than that. You might also believe that they have a distinct competitive advantage, right, in the market that they're in that is not showing up in a cash flow projection. You might also believe that their management team is unique and is strong. And so you take all those combinations and you'll say, look, this is the asset value, but we're going to put a multiple on that of 2-3 times, right? You see that happen, by the way, all the time with high growth tech companies, right? Like you might value them, especially early stage, but middle stage too, at multiples over their asset value, right? You see that happen with a Microsoft when they come upon AI, right? You might build a projection of the revenue and the cash flows from that, and you might say, but you know what? I'm going to value it at even greater than that. Right. So this concept of companies being valued greater than their asset value or greater than the discounted cash flow is not an uncommon thing, which is why then people say, hey, maybe I should value high growth companies as just a multiple to revenue, as a multiple to EBITDA. And I think that's a very reasonable thing. And then what do? Rather than take net asset flow value or discounted cash flow, you take an EBITDA multiple and you look at all the peers and you say, everyone's worth 20x. These guys, I'm going to give 30x because I believe in them. And you've thrown away, the spreadsheets and the cash flows, and you say, let's just take a look at the peer group, right? And let's say they're in a really hot, sexy industry. They're doing AI and, throw away the cash flows, throw away asset value. I'm just going to take a multiple of EBITDA and I'm going to give them a 50x multiple, right? I'm Palantir. I don't really care what they're doing in their business with AI, and I don't care about what their revenues are. I'm going to trade Palantir at 50x revenue, right? So this is not unique to Bitcoin. First of all, the idea of a multiple to net asset value, and so people call it alchemy. I call it valuation. Right. And every bank and everyone who's been to, business school or studied corporate finance realizes that there's a time when the traditional models don't work. And you have to come up with a different way to value a company. Right. Our belief is a good way to value the company is take the Bitcoin yield. Right. And then take the Bitcoin gain, which is a function of Bitcoin yield. It's a dollar gain. Right. Like it's sort of like an earnings. Right. And take a multiple on that. Right. Right. And so we've projected, right, that this year, right, our Bitcoin dollar gain is going to be in the $25 billion range. And if we do that and you take a typical EBITDA multiple or an earnings multiple and you say, hey, what's the company worth if they had produced $25 billion in Bitcoin dollar gain? Well, perhaps you'll put a 20x multiple on that. But what if that number is growing 50% a year? Should you put a 30x multiple on it, a 40x multiple? It's not unreasonable. And you would value strategy there then somewhere between, right, $500 billion and $1 trillion. And then you can go back and say, well, that versus our net asset value of 60, right? Maybe we should be at 10, 10x NAV or 20x NAV, right? So it's not alchemy. This has been happening since the beginning of corporate finance and equity valuations. Is there's got to be a different way of looking at the enterprise value of a company than just looking at a straight, what is the asset value that it's worth, right? And so that's I think it's very reasonable. And then it goes back to the same thing you do with a technology company, right? What's the potential for earnings growth? Do they have a competitive advantage? And do you believe in a management team, right? Do you believe in Mike and I, right? Do you believe that having 3% of Bitcoin in the world, right, and having more Bitcoin on our treasury, 10x more than the next Bitcoin treasury company, do you think that's a competitive advantage? I sure as heck think it's a competitive advantage, right? And so then yeah, and then you go back to what's our earnings potential, and that's our Bitcoin, that's our Bitcoin gain.
Do you think there's a bias of, well, the tech companies, they produce goods and services. We can wrap our minds around that. That's where the earnings come from. Uh, but a Bitcoin treasury company like Strategy, they're selling a financial product and financing their balance sheet and earning or creating value from doing that. And that's not okay somehow. That
Yeah.
selling financial products is not okay, but selling AI is good.
Yeah, of course there's a bias, but the bias is not based on anything other than ignorance, right? Like in 1985, Microsoft, somewhere between 1985 and 1990, Microsoft received a valuation that was 20 to 30 times its earnings. And, its revenue was growing 300% a year. And at that point in time, all equity analysts only knew how to do a discounted cash flow as a way to value a company. So the entire conversation we just had around the idea of a multiple on revenue and a multiple on earnings, which is today very well understood with tech companies, was a complete innovation, right? Of valuing equities in 1985. And so go back to 1985, right? Go back 40 years ago. And the same conversation you and I are having now about how to value Bitcoin treasury companies was being had by very smart equity analysts, right, on technology companies. And Microsoft was the first technology company that they decided to start to value, right, based on a earnings and a revenue multiple. It was really a revenue multiple. And it was considered a complete innovation. It was considered blasphemy in the world of corporate finance. Nobody liked the idea. They're like, how can you do that? This makes no sense. The company's making no money, right? Like I have to have a multi revenue. The same conversation we're having now happened, right? Like it happened 40 years ago in the world of technology valuations. And so is there a bias? Absolutely, there's a bias. But this is what when you blaze new trails, when you pave new roads, people are gonna have to come along. Now, I think the difference back then was the personal computing movement was happening. The business computing movement was happening. So everybody was very easily able to grasp, look, I've got a Commodore 64, an Apple IIe, or IBM PC, and I have it in my household. Now there's going to be one in every household. I can very quickly jump to the conclusion that Microsoft is growing at 300% a year. They're not making money. We should go ahead and give them a multiple based on revenue, right? Literally in everybody's home, right? PC in everybody's home. So when the average consumer understands it, then it's easy to do that. Today, Bitcoin is harder for people to conceptualize who aren't in the Bitcoin world. Now, we have 50 million holders of Bitcoin in the US, so those folks can start to conceptualize what Bitcoin does for themselves personally. The jump to then, why should corporations hold Bitcoin? How should they hold Bitcoin? What is the proper valuation for a Bitcoin treasury company? That's a little bit harder of a leap. But people will get there. And it took about 5 years for people to get there in the technology software world in the 1980s. I think people get there in less time now, right? And a year or two, and look, most folks, the people that you and I hang out with, Pierre, understand the valuation methodology. It makes a lot of sense. I think we'll get there.